dive right into the things. So starting off, we're not actually need to start with a top of the layers, right? We need to start with the interest rates, all right? We need to explain those things, right? And then we need to go to all different sort of correlations through first, second, and third underlying dynamics, right? So just starting off, today's call is going to be all about first underlying dynamic. I know it's going to be a little bit, it's going to be long, but it's not going to be extremely, long as yesterday's, etc., because we're going to have this in three parts. I'm going to cover first underlying dynamics, second underlying dynamics, and third underlying dynamics in all different segments of calls. So tomorrow is going to be second underlying dynamics of markets. Um, that goes into detail about future projections, etc., But we're going to start with the top layer, and we're going to go into detail about quantitative tightening, quantitative easing, etc., like that. Interest rates right here for the people not already knowing it. Now, of course, this gets you a lot of data already, like just these interest rates and these specific prices, right? Tells you a lot of information already. Tells you since we know that the simple correlation. This is why this is correlation code. We're specifically talking about correlation from interest rates and what higher interest rates, lower interest rates does to specific currencies. So in theory, guys, in theory, everybody listen up. You can have this in your notes. You can do whatever, but please just overall have this somewhere noted down because this is like the simplest thing. So in the simplest, in a theoretical manner, and higher rate on any given currency, on any given country's interest rates should drive up, in theory, the that country's currency higher, right? So if an interest rate in a specific country is higher, um, that specific currency should see strengthened move, meaning higher prices. So in high interest rates, therefore, potentially should be, and I gotta explain why I say potentially. And then higher interest rate, therefore, needs or potentially means that the currency should go up or at least be higher than compared to other currencies. Now I'll explain why this is, and why this in theory. So it does not always need to be this way, because there is a few distinctions, examples of when it's not, and pretty much when you go into detail about specifically quantitative tightening, quantitative easing, and that's the thing. So I'm gonna explain as well. But specifically, right, and higher interest rates, like I said, should mean an higher currency. That is because provided you buy in government debt, therefore, you're going to be provided with an um, higher interest on the money you're holding, right? So if you're locking up money, meaning this is how government's pretty much locking up money. This is how central banks is locking up money. But how they're locking up money is by buying debt of a given country. Now, in higher interest rates, like what an interest, why like the specific central banks of a country use the interest rates to um, compress or expand inflation, why they use it to regulate inflation, why it's the main tool of their monetary policy. And their monetary policy, we're talking about central banks here. The central bank's policy is also something you need to have written down somewhere, but their main objectives is to keep unemployment low and to achieve a 2% inflation target. That's the central banker's main objective. All right, real freaking important to note this down. And they're doing this and they're achieving this and they're trying to achieve this main objective through monetary policy. And they can do different things, right, through these different tools they have. But one of the main tools they have in their arsenal is just this monetary policy, meaning controlling interest rates. Now, the interest rate set by the central bank is the set interest rate in the given country. It's the lowest interest rate you're ever going to get. That is, or that means that this is the low point of interest you're going to get. You cannot get, of course, you could get potentially, but now we're talking about majority or average, right? This means that the average is higher than the given set interest rate. So the 4.50, let's take an example, 4.50 interest rate of the US here, as you can see, that is the low target for a central bank to set interest rates. Like if you get an interest below that, it's not going to be profitable. And mortgages and all the rest of the components of an economy. Now we're not talking about these long-term, short-term rates. We're talking about all other interest rates you have, because if you take a loan, for example, that's a different rate, right? That's a rate on the loan. This is the interest, the primary interest right here. This interest, as you can see, this number does not mean the loan of houses. If you're pretty much going to buy a house, this is not the set loan, because this interest rate is the interest pretty much you need to pay for changing money between banks. This is the bank interest rates. And as the bank's interest rates is set at this limit by the other central bank, because that's why there's central bank, the whole economy is going to slow down. And their thoughts of slowing down the economy is to keep, of course, people people then saving, right? Because if you have a slower economy, you're gonna have less people spending money, um, going up shopping, which of course will drive down prices or slow the economy down, pretty much making the prices go down. Since if you have higher prices and higher prices and no one is buying, of course the price is going to stagnate, the wages is going to go up, and ultimately the inflation is going to shrink, which is why they're raising interest rates. So if you ever have inflation going up, you can see the inflation going up with different tools, but the primary tool is CPI, which is of course also something we're gonna cover in this call, which is why it's gonna be a long call, because we need to go through all of these individual news and what they actually mean and what you need to take into consideration of. Um, but specifically this, right, the CPI, of course, they're trying to control the CPI or the core inflation with these things. And if you look at what CPI is primarily composed of, it's different loans and etc. etc. So shrinking or pretty much raising this will pretty much make people save more money, driving down the velocity of money and ultimately slowing inflation in the country. That's the theory behind it, right? Now, when this happens, because now we're going to go into the correlation to the currencies or specific assets, right? So what this means in theory is that when people is saving money, right? Oh, I'm super sorry. I don't know if it's lagging. For me, it says it's good. For me, it says it's good. Internet. But just let me know. Is it good now? Can I continue? Okay, perfect, perfect. Uh, just tell me once again if it's laggy. But yet again, right? As everybody know. Okay, okay. Yeah, but as everybody know, uh, people not spending money, locking up their money, creates the supply demand shift, right? Where there's still high demand from other speculators, etc., but the supply of the currency goes down, which of course ultimately then, if you're looking at a whole, an average, because of course money is not locked up, but in theory they become more locked up since you have a higher interest on the money, right? You have the velocity of money slowing down, right? You have house mortgages costing more to people buying less homes, etc., etc. Since they don't they need to save the money since the interest is higher. You get the drill, because I think everybody has experienced higher interest rates, or at least your parents, etc., etc., has experienced this, what it means with a higher interest in your given country, since we have had this inflation problem since COVID-19 in majority of the countries, right? So I think everybody knows how it slows down the economy by now. So it's hard to buy things. It's hard because people need to save things, which of course ultimately leads to slowdown in money, which means more money is locked up, which create the supply demand factors, which of course ultimately drives up the currency. Now that's how it should work in theory. But then you have poor central banks, or you have central banks not doing their jobs, not ultimately fulfilling their objectives of doing this. And so you have, for example, countries like Japan overall, even though they have a great central bank, they have had an deflation problem where people don't necessarily spend money, and they have actually had a negative interest rate. So they've had like the people get money for spending money, if that makes sense, because they are needed to encourage the money to go around, right? Which is actually crazy, like having a negative interest rate. But that in theory does not mean a negative interest rate. So this is why this interest rate does not necessarily mean the interest rate in a country, because you can have different interest rates in a country, but this is the set limit of profitable interest rates. This means that this is in theory the lowest interest rate you'll ever get in the country being profitable, meaning on average the interest rate in the country is going to be higher than 4.50 taken for the US, which means that the majority of the interest payments on house mortgages, etc., etc., is going to be higher than even 450, since having a 450 is the only way for them to be profitable, right? And then so if they need to be more profitable, they need a higher rate on interest rates. And then there's short term, medium term, and long term interest rates, which is something we're going to go through, and it's an average. So it's not the set central bank interest rates. You need to understand this. This is the when we're going to talk about the medium, low, and high, or I'm sorry, the long term, short term, and mid term interest rates. We're not talking about central bank set interest rates. We're talking about the average interest rate in the country, right? Which is why I have short-term interest rates, long-term interest rates, and intermediate-term interest rates. But this is the majority. This is the set interest rates. Now let's go into what the central bankers actually are looking for, because we are looking at the same data as them to determine if the interest rate should go up and the interest rate should go down. And this is ultimately what impacts news. Why you have news impacting the markets, impacting it with correlation, because news correlates into the markets, right? It's fundamentals. I'm gonna go through it, even though you don't necessarily need it. It could be good to understand it, because I've had a lot of people asking about it, and I need to go through this. So, starting off, we can just take a few news, right? News events of this specific date, right? But some things you need to know. Personally, I would advise everybody to, listen into the Fed Chairman Powell as a simple understanding of how fundamentals work. You don't need to go into detail. You just need to know what the central bankers are focusing on and those specific news events. And specifically, don't trade those news events, because those news events are the real high impact news events. So that's why you actually have PMI, CPI, non-farm payroll. Uh, you have um, I don't know if I've talked about Jolt Opens, ADP not for payroll, which comes out every month, right? So those two I would read as a trader at least. This should be basic knowledge. I'm super sorry for not potentially explaining this, but if you want to be a real trader and want to be like a professional, this is what all real traders read, right? You need to read the risk report of central bankers, and you need to listen to his Powell speeches, because in the Powell speeches he tells you literally what he's focusing on at the moment, right? So I would tell you guys simply that he's focused on unemployment, and I can actually tell you pause what I have talked about right lately. So the highest risk right now, and this is why the interest rates, this is a real time example of me explaining potential fundamentals. You don't need to focus on this. You just need to focus on because in a sense, right? And listen, everybody, this is what's really freaking important here. This is what is extremely important here, all right? Then I'm going to go into the real-time example. But what's extremely important here is not to pretty much understate this, because this is an overstatement. This is majority of how we're focusing on. Why I'm telling you all to not have a fundamental focus and instead have a central bank focus is because it's not the news. It's not the news in reality which overall it takes the currency higher or lower. It take Nasdaq higher or lower in a sense. It's not the news, all right? Nasdaq is a little bit different, but now specifically talk about currencies and yields. It's not the news which takes the currency higher or lower, and the yields higher or lower. It's the decision making of the central bank. It's their monetary policy which takes it higher or lower. Now understand the shift. A lot of people think it's the news, but the news only correlates to monetary policy, and then the monetary policy is implemented, which then moves the currency in the direction. All right, so it's not the news. The news have an impact on the markets, but in the long run, in the long term, it's the monetary policy having the real impact on currency. This is why we're only focusing on the monetary policy of the central bank, aka a central bank perspective, and not the fundamental focus. Fundamentals lead to monetary policy. We only need monetary policy to understand where currency is going to go long term. bam, like this is a crazy step forward. But you still need to understand fundamentals. You need to understand for you to understand what the monetary policy is doing, right? If you know, that's how it works, right? So it's step by step process, all of this. So fundamentals leads to decision making of the Fed, and then the Fed acts, which moves the currency long term, short term, but also other assets. Since, of course, a higher inflation, for example, or deflation, let's say, so lower inflation than 2%, potentially could lead to a recession or other things, right? So it could lead to other things other than those as well. We can have inflation, which can impact, because if you have a high CPI, let's say CPI, let's say going higher, like, and this is something we're gonna talk about as well. So like going higher or lower, right? It depends on what it means, right? But if you have a CPI going higher, it's a higher probability chance of the monetary policy being hawkish, meaning higher rates. Higher rates slows down the economy, meaning slows down the growth of companies, etc., in the long run. But also, of course, strengthen currencies, which gives the companies a harder time, right? Which is exactly what we've seen, which means you should be bearish, right? It's a bearish business cycle. Then business cycles also has a direct correlation to interest rates because you have an expansion, decline, you have the cycles, right? And you have the cycles specifically because inflation works also in cycles, right? It's a cyclical event, inflation. So you go from a low inflation to a high inflation to a low inflation. This is something we're going to talk about. This is why this call is going to be so long and why we need to divide it up into 3 parts, because I need to go into all of this detailed stuff for you to understand um, real things. But looking at it here, all right, what the central bankers are specifically focusing on, we can go into charts. This is the thing I would use the most here. So you can read about like what it is here. The number of individuals fired unemployment claims, actual less than the forecast, good for currencies, released weekly, blah blah blah. The nation's earliest economic, you can read what it is here in etc., and why it has like why the trade should carry. You can actually do this. Like this should be your homework because I don't know. I don't think anybody have done this. But zoom it out here, you can see right here that starting COVID-19 here, as you can see, we saw this big unemployment claims. Well, what happened when we had unemployment is high? Well, unemployment high simply correlates to a low interest rate. So here we had a low interest rate since the economy needed to get rolling, and low interest rates therefore means the government can spend more money, meaning you're going into quantitative easing, which is, we're going to touch upon this as well because that's the first unlike dynamic thing. So all of this, which I've talked about, is fundamental analysis, but fundamental analysis is what controlled first unlike dynamic. First unlike dynamics is just interest rates. Now we're not even going to talk about, we have not even started talking about long-term, short-term, intermediate-term interest rates, but this is just real important talking about fundamentals first of all, so everybody have the basics of fundamentals covered, so you can just expand upon this yourselves, or we can just talk about it when you want. So you can see here, and you can see it has been this way, pretty much past years. You can see it goes in waves as well. You can see it goes from low unemployment to high employment to low unemployment. It's also working cycles, right? Where you have people being laid off, and then people rehired, and then you have people being laid off, etc., and usually it's not really realistically how it works because you have lower segments. COVID-19 was an extreme. This is why if you have it like this, you cannot see the smaller shifts here or the major shifts here. But you see we had this major shift here, low interest rate environment. Since high unemployment, right, means overall low interest rates. It's a negative correlation, but it does not always need to be that way. It depends on what the central bank is focused on the most for them to decide monetary policy. And this is why, now we're going into the real-time example, the Fed is in a very difficult situation in the US specifically. This is why we should see a higher strengthening currency, since the Fed is in a very precarious situation, having um, you know, potential for a recession while still being in an inflation period, right? We still have, you still have high inflation, higher than 2% CPI in the US. We can actually look at the previous CPI event and see that it was higher than 2%. So the central bankers don't know what they should do, if they should focus on unemployment or if they should focus on inflation. Keeping the inflation low means at higher interest rates. And for them to have the inflation going lower, right, they need to have a higher interest rate, but then at the same time, that having a high interest rate would also cause the probabilities of a recession to go higher, right? Which would, in that case, cause unemployment, right? And their job is to do these things, is to hold both inflation and unemployment low, right? So their job is to do both of these things. However, they're in an extremely hard situation because both of these things are pretty much hard for them to take decisions on, since you have Trump, right? And Trump pretty much is pretty much causing both inflation, but also the risk of a recession to go up at simultaneously, which is why they have not changed the interest rates at all. We need to look at the interest rates later and then focus in on those, but we need to start with unemployment here as well. So let's go and look at the latest CPI events here, since that is more interesting looking at the charts. So we can see here latest CPI events. This was unemployment claims. But I would look at the charts here. Right, and I'll show you a simple way to do this. I think it's crazy how no one talks about this, but I don't know. Like it's crazy. It's crazy. It's very sad. It's very sad. But you can just simply do trend lines on this, and that's literally the way I do it. So you can see year to year is what you should focus on. You have 2.3. All right, 2.3 inflation, right? 2.3, which means the inflation in the US CPI, core CPI, the core inflation, right? Core price inflation, I think it's called, year to year. This is what you should focus on, not month to month. Month to month can tell you some things, but you should focus on year to year, right? So the 2 points central banks need to focus on, and this goes for all central banks, is keeping, or I think there's some potential individual central banks which has different objectives, but the majority of them has the objectives of keeping unemployment low and keeping inflation low. So inflation low, like having a country stably growing, right, with inflation at 2%. This is why they're trying to push down this to 2% with a high interest rate, while also keeping the unemployment low, meaning keeping people employed and happy. That's the central banker's job. Now looking at this, you can see inflation goes in waves here. Very interesting. So it goes in waves. And this is where we're going to business cycles here. Everybody listen up. It's not direct business cycle correlation, but as I've explained, we have business cycles thanks to that inflation goes in cycles. This is something you have to realistically you have people, human behavior, people pretty much acts like flocks, right? So you have the flock human behavior pattern, right? So when we have more spending, that causes people to spend more faster since their money loses a lot of value and they don't want to lose a lot of value, right? Meaning they want to go out and spend, which just causes this cycle to get exaggerated. So when you have high inflation, that means people are spending lots of money. The velocity of money goes higher. And you can actually read about that correlation as well in the fundamentals. Uh, right? So that's also pretty much a correlation you could read about, which is of course something you could note down. But when people are spending more money, high inflation goes higher. That means that the money's value diminishes since you have more money in circulation, right? Uh, this is supply demand factors, which just causes people to spend more money since they feel like not spending the money will lose their purchasing power, meaning saving, etc., will pretty much diminish their savings, right? Which causes them to spend more money, which causes a higher inflation, and you have the cycle repeating, etc., Now the same thing goes for deflation. So deflation overall is caused by a decrease in inflation. All right, it's the opposite, right? So it's the exact opposite of inflation. Now, deflation, right, is when people instead stop spending money. Now, this also gets exaggerated since you have the flock tendency of people also pretty much when stopping spending money, their pretty much savings goes higher. They pretty much, I'm sorry for this, guys, super sorry. But then overall, they stop spending money, right? Since they feel like the purchasing power goes higher, right? The purchasing power goes higher. Why does the purchasing power goes higher? Because the purchasing power, because the money gains value when you're in deflation, right? So you gain a lot of value in the currency, or not in the currency per se, but in the that because prices go lower, right? The money you already have in your saving accounts, you can, spend more and buy more things, because the rest of the things, since no one is buying it, the prices goes lower. So you have more purchasing power. Hopefully everybody understands. I'm not an economist, so I don't know all of this stuff, but it's just fundamentals. You don't need to focus on this, but it's interesting. I think a lot of people have questions why this is the way it works, but it is the way it works. All right, this has always been this way. I don't know. I cannot change it. Right? It's not my fault. It's not it works this way. It's just works this way. Um, and you just gotta find this correlation. So having this inflation, right, and for the central banks to slow down economy, they need to have high interest rates, which of course causes people's spending pattern to go lower, right? Hopefully everybody understands this as well. So when they're saving more, inflation goes lower, and yada yada yada. That's the correlation between CPI and inflation. So CPI goes higher, higher interest rates, higher currency, right? Currency strengthens. Lower CPI means in terms of correlation to interest rates, lower interest rates. And as you can see here, what we've seen for the past few years is a lower CPI and a lower CPI and a lower CPI. But why are they not cutting rates? Well, it's an interesting question. It's just because they have not hit their 2% target here yet, and they have big uncertainty. So, in theory, lower CPI means lower inflation, or lower interest rates. I'm sorry. So lower CPI means, in theory, lower interest rates, but it does not always need to be this case. So it also follows the curve. So CPI higher, interest rates higher, because they're trying to slow down the economy, for them to push down this, and yada yada. You get it, right? It's a simple economic facts. But you can just look for, if you want to predict fundamentals, if you're into fundamentals, just simple explanation here, so you can just continue it, researching it yourself. Just use trend lines here. I just use trend lines. So if it goes higher, it'll probably continue up higher. It's Marco's principle. And if it goes lower, have a higher probability of it going lower. So it's just simple trend line. So now CPI is going lower year to year, meaning we should see a lower interest rate eventually. Um, and this is why, in theory, currency should strengthen at higher interest rates, but does not always need to. So let's go into the graph here. Finally, let's go into the graph here. I'm super sorry. So, looking at it here, this is also directly correlated to business cycles, since you can see interest rates also goes then in cycles. If you have people's behaviors going in cycles, that causes a direct correlation to the central bank's actions, which also moves in cycles. All right, really interesting. Now we started to go into real principles here. This is what business cycles is trying to predict. The business cycles is trying to predict where interest rates is gonna go higher, and what that correlates to in terms of lower term, short term, intermediate term, long term behavior of assets, which is why you have different asset classes going different direction at different times, predicting interest rates. Really interesting, which is something we're going to talk about in the next call. I don't think we have time because we have already been here for 50 minutes or something like that. I'm super sorry for it being, but as you can see, in essence, it works exactly like this. You can see it works exactly like this. So you can see it looks exactly like it, even, right? Like cycles here as well, which is why the market is to some extent cyclical as well. Really interesting, which is why you have business cycles you're following. But as you can see here, 2022, it started going higher here. We started getting month to monthly or for the quarterly raises here. Since every quarter you gotta raise or lower in interest rates. But as you can see, it's stagnated here, and here we pretty much kept the dollar at a high pace. And since it's stagnated here, 2023 stagnated, we also had currency stagnating. Now you can see we saw this big drop off right here. As you can see right here, starting 2025, early 2025, or this was late 2024. So late 2024 here, we saw lowering interest rates, lowering interest rates, lowering interest rates, and this ultimately led to this. Now we're gonna go into this and how this correlates to the second hand dynamic, and how this can help us understand the second hand dynamic, which is why this is real important. Since I've talked about interest rates being the set limit of where interest rates is profitable for central bank or for rest of the markets, right? Which is why you can get an inverse yield curve, which is why that probably leads to a recession. Uh, oh my gosh, we have so much things to talk about. We're gonna talk about that in the next call, so don't worry, it's gonna be a part 2 tomorrow. But hopefully, like, what do you think so already? Like, does this explain a lot of your thoughts you already had, and does it help you in some way? That's perfect, guys. That's perfect. We see. Okay, perfect, guys. Perfect, guys. That's amazing. So in essence, lower interest rates means lower currency. Higher interest rates means higher currency. Stagnated interest rates potentially means both, or stagnated currency prices. That's potentially what it means. It can mean a lot of things, right? It can go higher here, it can go lower. This is why we have the yields. The yields is much better than this, since the yields move. This stays stagnated until the central bank changes it. But we're going to talk about the yield spread, etc. tomorrow when we talk about the second dynamic. What's really important, and this is why we have other things we use to measure where the currency is going, like the yields, etc., etc. Since we can see this going lower and yields going higher, which is an inverse yield curve, which means then the currency should follow the yields. But the currency in essence always follows long term. Now you have already known this. Long term, it always follows interest rates, month to month, etc., etc. But first limit leads to second limit movements, and then second limit leads to currency movements, which is what we use. But first limit. But now let's go into other stuff. So moving away, this is why you have this as well, which is real important here. Look at this. This is why it's really important. This is why you have CPI, inflation rates, and you have it comparison worldwide, right? So you can, have two different things, right? So you can have, for example, the American ones, and you can have CPI monthly, but I would say annually is better. Update charts, and you can see here the CPI differentials between the different countries. So we'll see if this works here. Come on, update. We'll see when it updates. Update, come on. Why isn't it working? This is just slowed. Potentially, are you guys hearing me? Yeah, you guys are hearing me. That's perfect. So, here you guys can see. Oh, okay. Here you guys can see. Now you guys are seeing the Euro USD price. You guys are also seeing the American interest rate or CPI, and you can see the Euro CPI on average, right? Now you can see the interest, or not the interest rate, but the CPI is higher, aka the core inflation is higher in the US compared to the European Union, which means in theory, European Union should have what? Well, they should have in theory lower interest rates, which is exactly what they have compared to the American ones, which have a higher interest rates. And in theory, in theory, this should mean that EURUSD should go down lower, but that's not what you have seen. So this is why we have pretty much gone, away from fundamentals, right? But we're not looking at fundamentals. Instead, we are looking at first underlying dynamics, which is of course the main central bank, policy, which, does a lot of things. So looking at this, but this is why we have inflation. All of this tools is very good. No, no, no. I'm sorry. Interest rate comparison. This is the best thing. This is the best thing. So here you have um, the average of intermediate term, short term, and long term. And I would recommend y'all to look at both in terms of comparing in a central bank perspective of a first look at a month to month price where we should be heading for Euro USD at least, or for other currencies. So you can have, any of these currencies you can see here, and you can compare them to other currencies, which can give you a first dynamic perspective of any given currencies and where they should be heading month to month, or at least like what you should be focusing on, right? In an essence, right? In essence, right? So moving on here, guys. As y'all can see, you can clearly see that the Americans right here have a higher overall interest rate on an intermediate term. Now we're not talking about the interest rates set by the central banks. We're talking about the interest rates, average interest rates in the country. Hopefully that makes sense. All right. On an intermediate term. So in you have to take loans and then you need to pay back the loans. So this is like intermediate term interest rates. This is all interest rates. So this is yields, etc., etc. So like intermediate term yields, which is like 10-year-old yields, taken into consideration as well. So you can see it's at 5.33 here, as you can see right there. It's at 5.33, while the Euro USD one is overall at 3.66, as you can see right there. Now this means, in theory, you can update the start. Let's see. This means, in theory, that we should see, that we should be able to see. I'm sorry, I lost my words here. Just wait 1 second here, guys. Um, my brain, come on, work. My brain work. Anyways, yeah. This just means, in theory, that we should be seeing a lower USD, alright? A lower USD. Since we have a higher interest rate, aka a strengthened currency due to interest rates, right? On average. Meaning more money locked up, changes the supply demand dynamics of the currency. Compared to Euro USD, which is, or Euro, I'm sorry, Euro, right? Which should be weakened compared to the dollar, since overall you have more money there, right? You have more money, circulation, demand, supply, fundamentals, you get it, right? Supply, demand, blah, blah, blah. But in a fundamental sense, which means that the USD should be stronger and that the Euro should be weaker due to the interest rates. This is also, of course, due to many other different things. But in essence, this means that you should have the dollar, right, going down, strengthening. And since euro is before here, you have the euro hedge against the USD. Since the USD is strengthened, this means it should go lower, and the euro also go lower, since it should be lower euro, right? In essence, this is not what has happened now, but this is what we should see, and this is what I'm looking for, therefore, in a first analytic dynamic sense. Now, long term, you can see the same thing right here as well, where we overall have seen overall the diminishment in interest rates, right, on both sides. So you can see American sides and Euro sides. But the thing which is real important to note here is that the Euro is still much lower compared to Americans, which means that we should overall, in a long-term sense, or like long-term interest rate sense, also see a weakened Euro. Now, in a short-term sense, this is the same thing. Same freaking story here, but we should see, as you can see, a lower Euro USD. So yeah, hopefully this makes sense, and hopefully you pretty much like this, right? So that's why, and you can do this with all these different currencies. I would highly recommend you doing it if you're trading any of these currencies, right? You can also do this for Dow Jones. You can do this for S&P 500, Nikkei 225 for Japan. You can do this for Nasdaq. You can do this for Dow Jones. You can do this for any other thing. You can do this for cocoa, gold, silver, whatever. And all of this has different supply demand factors affecting it, right? In essence, what's now changed is that we are to be very freaking bullish on the dollar. Now, this is what have changed, all right? Exactly. But now, due to that, we have, I'm just gonna tell you guys that previously, right? We have been pretty much trying to catch the bottom of the DXY, right? We have been overall, exactly, Lugs, exactly, you're 100% correct. But previously, as I said, we have been. I'm gonna answer all the questions, by the way, later, or in the middle of this call. But previously, right, I've been extremely freaking bullish, right? Extremely freaking bullish for the dollar. I don't know if you remember it, but I've been extremely freaking bullish. And through the fundamentals and COT, like the confirmation to the fundamentals being that bullish, I would also be bullish structurally. Now, this is what the fundamental confirmation engine changes in my trading. Alright? I'm actually not gonna be bullish for the dollar structurally. Alright? I've always tried to, when we are going into these regime changes, aka fundamentals shifting towards a more bullish stance, which it has been right now. So fundamentals for the dollar is bullish. But structurally, we're not bullish. So what were I previously doing? Well, previously I would go in and look for a bullish dollar. Now, this is what has changed with this fundamental confirmation engine. So instead, I'm going to still look for a bearish dollar. I'm still going to look for a bearish dollar. Notice it's a big change, right? It's a big change. This is because when I analyze the data, I don't know if you remember it, you can go back, the report is out, you can just check through it. I noticed that I usually, when we had big data shifted, I just took so many losses around these highs and around these lows, all right? And this was because when, for example, here, we had the COT shift towards a bearish dollar, you can see we still had 5-6 weeks of more bullish prices on the dollars, which caused me to pretty much have a wrong bias structurally, but not fundamentally. So notice I was right in the big move, but I was wrong in the small move. But the small move, since we're trading the small move, that is what caused me the most losses. Now, as y'all know, and this was actually, I would say 80% of my losses was because of this fault. You can go and check the report, you can go check the data, right? I'm going to try to explain this in the best way as possible. Um, but yeah, so as 80% of my losses was taken in these sort of areas, you can see right here, I was bullish on the dollar. I took a lot of losses here since I was bullish on the dollar. And since here I was bearish on the dollar, I also took a lot of losses, 2025, right? Um, this caused me a lot of things, right? A lot of anxiety, etc., etc. Um, in terms of the model, right? And since I took that much losses in this short-term moves, I needed to change something, and that's exactly what the confirmation price engine does. So now, hopefully, everybody know why it changes in my trading. It just changes the short-term perspective of the structural markets. It does not change the fundamentals themselves, since I cannot change the fundamentals myself, right? Hopefully, everybody understands that. And what it does is that it's more or less confirming the fundamentals being in the structural manners. And until the fundamentals are into the structural manners, I'm going to keep with the momentum, aka momentum trading. Alright, so now when here the fundamentals were pointing towards a bearish dollar, I could just take the highs here, this market regime, and I'm going to go through much more examples of this. And this market regime are all different. Alright, this right here is a momentum regime. All right, this is, see guys, this is why I'm so freaking hyped. All right, since this divides up parts which I've always completely screwed up, and like notice that this will pretty much enable us to become like, I don't know, but potentially even 10x better traders. All right, um, and this right here is called the momentum regime, all right? And I'll tell you guys what distinguishes this momentum regime from this regime right here. Um, and you can just pretty much, hopefully everybody have pulled up their notepads, etc., so you can take all these notes. Since all of this is really important, since all of this will change how we trade STA a little bit. So we never need to take these losses in the future, or these unnecessary losses, since all I'm doing looking at back at data is just trying to minimize and specify the number of STAs I'm taking, so they become even more precise of the trades I'm taking, and so I get much more profitable and get a higher ROI from the STAs we have in a given year. So this is a momentum regime, all right? Momentum regime. You can just write that as a big title, right? A momentum regime is overall when the structure is not aligned with fundamentals. Now, what a lot of people does in this situation, retailers, etc., etc., um, is just keeping with what the structure previously have done. But what we have done wrong in this period of time, in these weeks leading up to a big change structurally, is that we have pretty much stuck with fundamentals. So in this period, where the COT has confirmed a bearish hedging program for the dollar, we have been more or less changing our bias towards a bearish stance on the dollar already. Meaning we have been looking at an high, get informed, and we have been taking shorts in this, which has caused us to take a lot of losses, which I've previously explained. Now, what this changes is that we now trade with the structure. We trade with the momentum of the previous fundamental alignment with structure. All right. Let me tell you that again. So momentum trade just keeps is when structure is not aligned with fundamentals, but you have previously seen structure and fundamentals being aligned, meaning the momentum just continues until it doesn't, right? And I'm gonna tell you guys how we confirmed it does not, um, how we confirm that, you know, the structure is now aligned with fundamentals. All right, so let's go into the second regime. All right, second regime of where price could be. Now the second regime where price pretty much could be is fundamentals being aligned with structure. Now this happens when the fundamental price confirmation engine has confirmed a change in regimes. All right, now, a change in regimes is caused by 2 weeks in the opposite direction. So not just 1 week. I've tested it with 1 week. You can see right here, the COT changed for a bullish hedging program right there, meaning the confirmation for our fundamental analysis, meaning we were bullish right here, confirmed we were looking for a bullish dollar. But if we were to just look for a 1 week bullish close, we would still have taken these losses right here of this consecutive weeks, meaning we need 2 consecutive losses majority of the time to confirm the regime change. Hopefully everybody understands this. So when we've seen 2 weeks of bullish or in the opposite direction, meaning 2 weeks of structure change in accordance to fundamentals, meaning here we were looking for bearish, right? Because the fundamentals here were bearish, confirmed by the COT bearish hedging program. 2 weeks of lower prices here would then therefore confirm a lower dollar was in structure as well. So then you move to the second regime. Now the second regime is just normal STA regime. I don't know, I've not come up with a name for this. All right, I just call this the momentum regime, and I don't know what to call this. Any thoughts of this regime name for this regime? Someone of you guys could have the honor of naming it. Potentially, you have the chance to come up with this for next week. I'm also going to show you after I've talked about this, the data I was to go through analysis, but it's really impossible to go through analysis without talking about our new methodology here. So any name suggestions? I'm just going to wait a little bit here to see if anybody have come up with any given name for this regime. We'll see. Yeah, where we make our money, alright? Where it's easy to understand price. Where it pretty much aligns with us. Yeah, exactly. Sestive regime. We can just call this just distribution. Alright. And a distribution regime. Yeah, we can actually call this distribution. Yeah, that's good. So the distribution regime, alright, is caused by us more or less having fundamentals and what people would call technicals or structure aligned, right? So liquidity and momentum and fundamentals align. All right, so people have noticed the fundamentals, they have acted on the fundamentals. All right, and they're now trading with the fundamentals. All right, so they're trading and pushing down the lower dollar until it's then, you know, going from an overbought to an oversold. So here it was overbought, now it's going to an oversold period right here. So yeah, it's just the distribution phase. We'll just call this distribution phase. Now, then it's going into its next regime. Now, the next regime is just this momentum regime once again. This is where it's in an oversold period. All right, it has moved more in accordance to its equilibrium position, in accordance to liquidity, structure basis, etc., yada, 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 but is still following the momentum caused by this. All right, it's still following the momentum caused by this down move, right? Meaning people still believe in, or institutions still believe in a lower dollar. All right, potentially here it's just retailers and large speculators I'm referring to here. But fundamentally, we are to be very bullish. But momentum is still down. Meaning, if we were to look at, for example, a bottom tick here, we would take a lot of losses because we know a bottom should be formed somewhere here. But the momentum is not with us yet. All right. And as it's not with us yet, we would still take a lot of freaking losses. All right. A lot of freaking losses. All right. So the momentum here, exactly, it's very freaking good. Very freaking good concept, right? So the momentum here is still very freaking bearish, and so we are to keep with the momentum until we have 2 weeks in the opposite direction of bullish closes. All right, so when we have 2 weeks of bullish closes in the opposite direction, All right, so 2 bullish weeks here. We know the bottom that is therefore in, and we know that structurally we are to follow a higher dollar. All right, now these 2 weeks, all right, since I've looked at the data and I'm going to publish the data, I know that 95% of the time, all right, exactly, it's very reasonable. If should be, but we always guess tops and bottoms, but it's just where we lose. Exactly, bro, it's where we lose our money. Yes, this will 95% of the time lead to more losses, all right? How it cannot lead to, you know, how it can, our previous things, like our previous theory was that, well, we just establish a level here, we just short the shit out of it, and we try to be enigma and take, the tops and the bottoms, and not trade with the momentum and trying to catch where the momentum will change. Instead, I think that's very unreasonable, since we have note during the losses, majority, at least 80% of my losses occurs in this areas where I'm just pretty much not trading with the momentum, right? So 80% of my losses occurs in these momentum regimes, while 90% of my profits occur in this distribution. I'm sorry, like the wins I take, like all the wins I take, like nearly all the wins I take at least, um, occurs in this distribution regime, right? Whereas 80% of my losses occurs in this period right here, all right? 20% of my losses occurs here, right? And 5% of my wins occurs here. 5% of my wins occurs here. So just shifting this will just cause us to have like such, so much better of an confirmation. Now, what this potentially could cause, all right? Since we still need to have terminuses, etc., etc., all right? So remember the previous things we have used. So I've just pretty much thought of this. So it could still fail. I'm gonna try to have it the next time. I'm gonna actually also show you guys, but I just need to show you guys this so we can go through it real time as well. No, like on the charts here as well. The regime changes. But here you can see some of the data. I'm gonna show you how I got this data as well today, etc., etc. Since I've always promised this, but you can see how well this works. So you can see July 2023 bullish, right? The new COT regime, right? 2 weeks, price closes after, up, right? Confirmation met, yes. Trade taken, long. Resulting trend, 3 to 5 weeks after, right? Resulting trade, 3 to 5 weeks, uptrend. Correct call, yes. All right. So the only times this didn't happen was twice. All right, right here was twice. All right. Um, and the thing which has happened now is and the price. I'm gonna go through this. I'm gonna go through the data with y'all. Uh, just looking at this, right? We have been looking at, look at this, right? We have been looking at, oh, this has shifted. We have gone up, so now we should be bullish. Look at this, 19 December, right? 19 December here. We have been looking at, oh, we should be bullish, right? And this is where I'm gonna go through the previous data, right? So how this confirms everything, right? So we're gonna go through it. We'll just start right here. We'll just start at this regime change right here. So here we went from overall a bearish hedging program, as everybody can see, minus 20,000. So I'm gonna go through all the things with y'all right here as well. Just double confirm it so everybody can see it right here as well. So we went from minus 20,000, aka bearish hedging program, right here to 19th December. Look at this, 19th December 2023. This was pretty much 2 years ago. We can go through even more data if you guys want to, but I think this is a very good start because you guys can go through this yourself. And I would not recommend you guys, when going through and when uploading CVV size, etc., etc., to of previous COT data. What I would recommend you guys doing if you're backtesting COT, etc., through large language model is make the large language model deep search and go into the data itself, right? So instead of uploading pictures of it, etc., etc., let it research the previous, because it's public knowledge coming from futures COT legacy, right? Legacy reports each and every week, right? I don't know what the group is called. Potentially CME group, right? Those are the CME regulators, right? Those are the ones publishing. So you can actually ask your large language model to go in and deep search the data previously for any given assets, right? And let it do that so you have all the numbers, because it cannot analyze pictures. Remember, it cannot analyze pictures. You can potentially explain how you read COT through pictures, etc., etc. But it's better to just visually go through it with numbers and then let it visually itself just go through the data, right? I would recommend that because I've also tried it with pictures. It becomes less accurate, etc., etc. What I would also recommend you guys doing is upload CSV files for the previous data, which I previously explained for your large language models. This is I did not learn myself. Of course, a little bit I learned myself, but majority I learned from other quant traders I've just searched up. All right. I'm not that smart, as I said. I don't even know 10 plus 10 nearly, right? But looking at this right here, let's go through this. All right, since I've also double checked this, yada yada yada. So I've not just, as you know, you cannot let it up to be a large language model which decides these things. All right, is you cannot, right? You need to double check the large language model. You need to double check so all of this is correct, etc., etc. Um, since it can make, big mistakes, right? Um, exactly 2 weeks of opposite direction. It was not me. I back tested it, of course, through large language models. So I tested it first I asked it to test with 1 week, 2 weeks, 3 weeks, 4 weeks. All right. And it came up with that 2 weeks established was the best in opposite direction for confirming another 4 to 5, 6 weeks in opposite direction as you read. So I asked it to go through all of this and establish which, or potentially are we looking for 1 week. You can actually go through this now. We'll actually look at this right now. So because I think, just by looking at this previous 2 year data, you can really establish the relationship just looking at this 2 year data, right? Even though for when you're operating with large language models, you should use at least 5 different assets, I would personally say, and go through at least 5 years of data, right? 5 years of different data for these given assets. But I think everybody here can establish a relationship. Like asking yourself these questions right now will pretty much be answered because you can see a clear relationship just looking at this 2 years data as well. But let's go through it. I'm sorry for holding you guys up. So as you can see right here, fundamentals, the fundamental confirmation. Also, all of this is also through fundamentals, so it's not just COT confirmation engine, it's a fundamental confirmation engine. Remember that. So it's a COT plus fundamentals, but I'm gonna show you fundamentals since those are easiest for you guys to visualize and go back and just read about it. But I want you guys to go through it. It could be your homework, right? So to do these things, I think everybody have a clear understanding of how we're doing it because I've gone through it previous days, right? Anyways, sorry for the yapping. I just need to explain all of this, just cover all of this up so I can just clearly explain all of this, right? Everybody understood this, hopefully at least. Now let's go through it. Let's just jump through it. So here you can see clearly bearish hedging program, right? Minus 20,000 previous, looking at, you can just judge it because we cannot add this data. So from this period, looking at this period, the lowest point were to be here and the highest point were to be here, right? So we would just divide this by 2, you get minus pretty much 10,000 right here. So if you are above minus 10,000, we are bullish hedging program. You already know all of this, right? Hopefully everybody watched the COT call. So minus 20,000, right? We went from minus 20,000 here to on the 19th December, one day, or not, 1 week, right? To a bullish hedging program, as you can see. So now, normally, we're going to compare this to our normal bias as well. Normally, we would be straight as bullish, all right? But let's look at what actually price did. So remember, 19th December, it actually changed. Notice, 1, 2, 3, 3 weeks down, all right? So if we were to change, or actually 2 weeks down, so if we were to be having a bearish bias here, we would have taken 2 weeks of consistent losses, all right? Because remember, when we are looking for a like our model is built on mean reversals, guys. So if price were to be bearish, remember we also have a higher likelihood of actually taking losses because we have a higher likelihood of taking trades. Because if you remember here, we are looking for then sell side liquidity to get taken because we are looking for buy side liquidity to get taken. So in accordance, if we're bearish, you have a high likelihood of sell side liquidity getting taken, and that would confirm a trade because we have bullish fundamentals, meaning the occurrence of a loss would be greater during this period as well, which is very freaking important to note. And I would not know these things if I were not collecting data. So notice how freaking powerful. Notice how much you guys' mindset have now changed when I've gone through this real in-depth stuff. Right, so since we're looking for sell side liquidity, sell side liquidity sweep because we're looking for buy side liquidity to get taken out. Since we were like previously having a bullish buys 19th of December, remember hypothetically here we were to have it, right? But now since we pretty much want to avoid these losses, we are changing this up. So instead we would trade these 2-3 weeks, right, with the momentum. So we would keep being bearish here until we see 2 weeks going against us. All right, 2 weeks would have been here, and then you would clearly see after 19 December. Look, this was like, let's say this regime change was, I would personally say, 3 weeks delayed, right? As you can see, 3 weeks delayed. You can see 1, 2, 3, 3, and then the regime starts, the real regime. So this was 3 freaking weeks of delay where we could have taken, immense losses looking at, right? But now, just using this, we would pretty much avoid trading when we saw this week going against us. Then we would wait another week. So we potentially just have taken 1 week, or like 1 week if we were trading like once a week, which I average do. I would take 1 loss instead of potentially 3, 4. Because remember, when we are having a wrong bias, we have a very much a high likelihood of taking a loss, since especially during these momentum periods where we usually form lows and highs, we usually manipulate. Remember manipulate? Look at the CBV, right? Confirm this with volatility. We usually have higher freaking volatility during these periods, which would incur lower, since it's going lower, it would also be more volatile, meaning higher probability of sell side getting swept. Meaning this is why I've taken 80% of my losses in these momentum, in these momentum positions. Notice how freaking smart this shit is. What do y'all think about it so far? Just explain and not just showing you guys this data. I'm gonna go through all this regime changes, but what do you think about it so far? Do you like it? Why do you like it? This is crazy, guys. It's amazing, guys, right? We are 10x this shit. We are 10xing this shit up crazy much, alright? This shit is gonna go crazy, guys. Like, this is crazy upgrade. Notice, like, how powerful just by looking at this is crazy, guys. This is how you change your model for the better, right? We changed our model now, but we changed it in accordance to data. Like, this is not looking at structural things even, right? Remember, a lot of people, all the people out of here, like all the other ICT traders, oh, let's take this fair value gap here. We're freaking not taking these. We're looking at freaking quant shit. We are looking at freaking quant shit here, all right? These ICT traders can cry, alright? But we just notice it. Like, notice this powerful information you get in here. It's crazy. So now we have a bullish regime change. We have confirmed it through these potential 1 loss here instead of 6 maybe, alright? And then we're pretty much trading here, bullish, bullish, bullish. Like, notice, it does not change right here. The bullish program continues, continues, continues until we move past the minus 10,000 line. And I would personally say this was 18th of June. It's in Swedish. All right, so I don't know what this is in English. Potentially July. All right. So I would, let's say we actually moved past it. Yeah. I'm sorry, my eyesight is very bad, but 18th of July, I would personally say 18th of July. Let's say where 18th of July was. All right. In this case, we had already pretty much been bearish, but you can see we had already pretty much, I've not, done these fine changes, but potentially we could add in that, well, if you have seen 2 weeks of prior bearish prices, like bearish momentum coming into the markets, we could potentially change it up that this also confirms when we are bearish, right? But let's just wait. So here you would potentially take, here's some more bearish prices, right? Bearish prices. And here, we would have these bearish buys, as you know. Since this 2 weeks price action, we did not take into consideration this starting move, since the regime change actually occurred 18th of June, and we don't take this into consideration yet. All right, we don't take this in consideration, even though I was trading here and I was bearish over here even. Um, since we swept this liquidity, yada yada yada. I'm gonna take a more quantitative approach and a more bad approach, because you should always take the bad data. So it's personally say here, I would potentially have taken, like, let's say 2-3 losses, right, and then 1 potential more loss, right? But then our regime change would change and we would pretty much come in. But this is just one time. This is just one time occurrence. anyways, now when we have this in, you can see we had a lot of weeks of pretty much seeing bearish prices here, since we are in bearish hedging program territory here. You can see bearish hedging program territory until that changed the 17th of September. All right, 17th of September was more or less here, so we would just wait for 1-2 weeks of, let's say here, 1 2 2. All right, and then we would be bullish the rest right here. All right, so here it would work perfectly here as well. You see, we would potentially have taken 1 week of losses. We not have missed anything, all right, compared to what we previously have done. If you remember, we saw the change right here, 17th of September. I don't know if there's any way of zooming into this, all right, any way of zooming in, but you can see right here, not right there, and right there, not the last candle here, right there. And we would have traded with the momentum, so we would pretty much be still bearish here, bearish, until we saw 1-2 weeks of opposite direction, right? And here we would potentially take in, you know, 1-2 losses, right? Let's say, but instead of taking multiple losses. Now, let's go through this period as well. So this period we were bullish, 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 bullish until we cross the minus 10,000 line right here. And this is where it pretty much becomes extreme, because here, you see, it has been very clean. But this last year, 2025, this is why I needed to come up with this engine, right? With trading with momentum, changing regimes, etc., etc. And this would have just helped me so much if I were to come up with this earlier. But you improve with time. I'm not perfect, and this is why I love trading, because you can always become better. But let's go through this. Minus 10,000 right here. We move past minus 10,000 here on the 7th of January. 7th of January was more or less right there. Right there. We move past the minus 10,000 line. Here we would wait for 1-2 weeks of bearishness, and then we would have been bearish, right? But since, all right, what I did wrong here, and I don't know if you guys can go back to this period, but in January, right, already here, and this is a something for the euro, I had already changed my mind. So I'm sorry for switching to euro here, but here I had already changed my mind, since notice here 19th of even potentially earlier. Remember here we took the highs, lows, right? Middle point was pretty much, let's say it was the zero line, right? We went past the zero line here on the 21st of October, right? I mean, I was changed 21st of October. Where was 21st of October? 21st of October, right there. I don't know if you remember it, but I had like such a wrong bias here. 21st of October. I was changed for a bullish bias on euro. I was looking for this move right here. But here I changed my bias a little bit. I took it consideration that I was looking for a higher dollar, but I was never looking for an high. We can go to the 3 year. I was never looking for a higher dollar, which would have taken this high. I don't know if you remember it. I was never looking for that high of dollar, and so I was never looking for this low of a euro. But since if I use this, I would have, here all the way here I had wrong bias, all the way here, until we saw this regime change on the dollar. Then I finally, realized we were changing here. And with this, right, I would still trade this momentum trade. All right, since you can see the low drop on this bullish, bullish, bullish euro here, bullish, bullish, bullish euro for this catalyst move up here. So I would still trade this momentum trade lower for euro. I would still have this euro bearish bias, which would have solved so much of my problems, right? So much of my problems. Similarly, right, we can go into the detail about this bullish hedging program, because this is a real-time example, guys. This is and you have seen how freaking bad we have traded FX throughout these past weeks, right? But you can see right here we have been freaking really, and this works for all COT hedging programs, right? You should use this on multiple ones, so you should not use this only on one. You should use this on two. And I've not specified like why if euro goes, goes 2 weeks in direction of the fundamentals, and the DXY goes 1, in the direction of the fundamentals. I'm not specified those parts. I need to still check it, but that's why I need your help with, because I need you guys to also help me come up with these rules, etc., etc. It takes a little bit of time to develop it, but this framework still establishes just a much better framework from the past framework, because remember, earlier we did not have this specified. And a specification of this just makes it 10 times better already. But now I need to make this 10x better even further, right? This is trading, guys. So let me just move past the minus 10,000 right there on let's say 1st of April. Well, let's be nice, or let's just say here 13th of 18th of March to be precise, right there, 18th of March. So 18th of March we changed to a bullish stance on the dollar. 18th of freaking March we changed to a bullish regime on the dollar. Now notice here, if we would have traded with our previous concepts, etc., etc., we were overall bearish here still remember, because the euro had not changed here. But I was looking for fundamentals to be bullish. I was looking for bottom. I was trying to take Enigma. I was trying to take pro ICT trades. But now we will trade with a momentum, so we will still be bearish here, bearish, 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 until we have seen big momentum shifts in the markets, meaning 2 weeks in opposite direction, meaning 2 weeks lower. All right, potentially I changed it up so it will not be like, this potentially, could have confirmed it, and then this would have disconfirmed it. But this is why we have terminus, etc., etc. So now we'll just continue trading with our momentum regime right here. But what do you all overall think about this? All right, do you want me to show you guys on, for example, with GBP, how this would have helped us on GBP or on Euro now? Because Euro is, same thing as the dollar more or less. But we can go through this if you guys would like to. Otherwise, you guys will do it yourself. But everybody understand the confirmation or fundamental confirmation engine? Is this good for Nasdaq? I've not checked. All right, if I'm honest, I've not checked. I've just checked for all the FX. I've just checked for all the FX. But if you want, I can check this like statistically or quantitatively for the next call if you guys would like to. But otherwise, I'll just go into, yeah, I'll just do this for the next call then. Next call, by the way, will be tomorrow, right? And we will pretty much have that call about pricing purity model, right? So that's pretty much what we're gonna go through. It's another fundamental thing, which is very freaking good. But we'll go through more of this tomorrow as well for Nasdaq, etc., etc. I just need to go through it, right? I've not done it yet, so I'm gonna go through this as well. But you can clearly see how much better this works for us now, and how much better this will work for us now. Compared to what we previously have taken losses, we will now take wins, right? So let's go through this in the markets right now. So now hopefully everybody understands what I'm talking about. So let's just go into how our analysis now have changed on the dollar, right? So looking at the dollar right here, as y'all can see, weekly, right? We have more or less seen from the 18th of March, I don't know if you remember it, 18th of March, more or less right here, we have been bullish fundamentally on the dollar. So right here, from starting right here, right here, right here, right here, right here, right here, we have been bullish on the dollar. The dollar has been bullish, right? Liquidity based, we have not been bullish since we have not taken these equal lows. We have not taken this, but now liquidity based, we are bullish. The only thing we need to wait for now is momentum to change, right? So the only thing we need to wait for is 2 weeks of confirmation higher, meaning fundamental confirmation engine need to confirm a bullish dollar, meaning 2 weeks of opposite directions. Since we have seen, the week here being bearish, 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 I'm gonna continue with the, bearish momentum regime here. So I'm gonna stick to a bearish bias on the dollar, even though fundamentally and structurally we are bullish. I'm gonna continue with a bearish dollar until I'm not bearish. Hopefully everybody understands this. Statistically, this, as I showed you guys, will work better, since statistically it's you know statistically it is more likely that we will have the next weekly close bearish, since we've seen, the latest weekly closes being bearish, right? It's Markov's principles as well incorporated into this, as you hopefully understand. And you can go through, we can go through some regime changes, right? But remember here, I'll just go through some of them. Remember here, we had these three, this is what I went through in the beginning of this call. This was momentum trade. These 3 latest weeks right here, momentum, all of this was momentum trading. Then we had 2 weeks of opposite direction, right? Potential confirmation. And then we had the rest of the bullish. This would have been the distribution regime, right? Remember this? Then we had 2 weeks of momentum right here, I would personally say, or something like that to the extent. And then we had distribution regime. Then we had momentum regime. Then we had distribution regime. All right. Then we had momentum regime. Then we had distribution regime. And now we're in another momentum regime. Hopefully everybody understands this. All right. Anyways, everybody understands this now. Let's just hear some yes and some no's. So if anybody having any trouble understanding our new confirmation engine and how this changes our buys. Yes, perfect guys, perfect. So now we'll look at price a little bit differently, but this is through statistics, as you all know. So potentially, oh, it makes sense as well. That's perfect, guys. But potentially, some of us will like some people will hate us, but actually, majority of retailers make most of their money in momentum regimes. This is also where most of ICT traders make their money, since they are just looking for um, yes, this is in the new addition to yes, this is like the new STA. This is the STA 2.0, right? Which we're going through. This is like the new rules, etc., etc., or new definitions for things, etc., etc. So it's just yes, I'm trading bullish STAs tomorrow on EURUSD. See how like this makes us being able to trade more as well. Like notice these changes are quite major, since this enables us to trade more and take more wins. Um, but majority of what is it called? Majority of ICT retail traders actually makes most of their money in these momentum periods, and this is also the periods I get most hate of, right? I get majority of hate in these periods because in these periods we are always too early in calling a high. If you remember, like I usually, at least this goes for me personally, I am personally getting the most hate in this periods for being bearish on the DXY when the price is going bullish. All right, because all other ICT traders, all other people are to be bullish in this period, right? And I'm saying, oh, it's going bearish. Yes, it's going bearish eventually, but with this, I'm gonna pretty much be able to make equal as much money as them, all right, in both the distribution regime and the momentum regime. And then we are able to capture another distribution regime. So price is you can call it you can call it like this. Price is going from an distribution regime to an oversold period, all right, where it's just going off momentum. This is where retail traders and large speculators pile in and make most of their money, right, in the momentum regime, just the final push of price. This is also manipulation. You can call this manipulation as well. Now, when we are in this territory, fundamentals will change from structural price. Now, after this, we will have another distribution regime. All right, another distribution regime where structure will be 100% aligned with fundamentals. This is where we make most of our money. This is what we call an STA distribution, right? Now, then you're going to go into another period of oversold, all right, of oversold in the markets. Oversold period. This is also another momentum period. Price is usually a little bit consolidated. It's not these big distributions, right? Price is usually a little bit more consolidated in these periods. Then you are going into another distribution period where structurally and fundamentally are aligned, right? Structural and fundamentals are aligned, and momentum, right? So those are the 3 key things, right? So including momentum in the trades is also what I'm going to do now. I've not included momentum. I've just looked at structure, um, fundamentals. Now I'm going to include momentum as well. What defines the switch from